Marcus saved $10,000. He did everything right. Opened a brokerage account, put it all into a broad index fund, and waited. That was smart. Genuinely smart. But Marcus is 43 years old now, and that $10,000 has turned into about $94,000. He is not a millionaire. The math never lied to him. He just never understood what the math was actually saying. Here's the paradox that changes everything. The stock market has made more people wealthy than almost any other asset class in American history. The Federal Reserve's survey of consumer finances shows the median stock market investor has seen real wealth gains over the past 30 years. The data is not disputed, and yet, according to research from Brookings Institution economist Robert Litton and published studies on American wealth formation, the overwhelming majority of first-generation millionaires did not build their wealth through passive investing alone. They built it by owning something that generated revenue, not something that merely appreciated. That distinction is the entire video. Stay with me, because by the 5-minute mark, I'm going to show you a specific mechanism that most investors never think about: the difference between a return on capital and a return on revenue. It changes everything about how you read a balance sheet. Priya also had $10,000, same year as Marcus, same economy, same interest rates. Priya used her $10,000 to start a service business, not a tech unicorn, not a dropshipping empire, a residential cleaning service. By year 3, she had 9 recurring clients, 2 part-time employees, and monthly revenue of $11,000. Depending on her profit margins, a service business at that revenue level would typically sell for somewhere between 1 and 3 times annual earnings, based on transaction data compiled by BizBuySell's quarterly insight reports. If she was keeping 30% margins, that put her potential sale value somewhere in the range of $100,000 to $300,000. On paper, in year 3, from $10,000. Marcus, investing at the S&P 500's historical average of roughly 10% annually, which is the long-run nominal return documented by researchers at NYU Stern going back to 1928, had turned his $10,000 into about $13,300 in the same 3 years. That is not a mistake. That is not a trick. That is compounding working exactly as advertised on a relatively small principal over a short time frame. This is the brutal mathematical truth about investing from a small base. Compound interest is one of the most powerful forces in wealth building, but compounding requires both time and scale. The rule of 72 tells you that at 10% annual returns, your money doubles roughly every 7 years. 10,000 becomes 20,000 in 7 years. 20,000 becomes 40,000 in 14 years. To reach $1 million from a $10,000 starting point at 10% annually takes approximately 48 years. That assumes no additional contributions, and it is verified arithmetic. 48 years. Now someone will say, what if Marcus added $500 a month on top of that? Fair. At $500 a month for 20 years at 10%, he would accumulate around $380,000 based on standard compound interest math. That is a genuinely good outcome, but it took 20 years, consistent monthly discipline, and still does not reach $1 million. The business path, done right, can reach comparable numbers faster. The inputs are just different. That is the whole point. Business ownership operates on a completely different engine. It does not wait for time. It manufactures revenue. Here's where most people get it wrong. When you invest $10,000 in the market, your return is capped by that $10,000. Your capital is the ceiling. But when you invest $10,000 in a business, your return is tied to customers, pricing, and systems. Those variables are not fixed. You can push them. The ceiling moves. Let me make this concrete. The vast majority of small businesses that reach $1 million in revenue do so because of one specific pattern. Every new customer becomes cheaper to serve than the previous one. Not because the work gets easier, but because the systems get better. When Priya hired her first employee, she could take on 4 more clients without working more hours. When she built her scheduling system, she could manage twice the volume without twice the chaos. A cleaning company, a bookkeeping firm, a software tool, a content business, a logistics coordinator, and every one of these has a structure where growth compresses the cost per customer. That compression is the business equivalent of compounding. Now let us talk about what Priya actually did with her $10,000, because this is where the framing shifts. She did not invest the $10,000. She deployed it as seed capital for a revenue generating system. The distinction matters enormously. An investment is a passive claim on future value. Capital deployed into a business is a purchase of future revenue generating capacity. The $10,000 paid for cleaning supplies, insurance, a business license, basic marketing, and her first month of operations. Those expenditures did not grow in value the way a stock does. They purchased the right to a revenue stream. And a revenue stream, if structured correctly, compounds through reinvestment, through hiring, and through systems, at a rate that passive capital sitting in an index fund simply cannot match in the early years. This is the 2-minute mark, and here is what I want you to hold on to. When a large S&P 500 company earns a return, that return gets split between employees, management layers, and finally, shareholders. By the time it reaches a passive investor, data from NYU Stern professor Aswath Damodaran shows the average filters down to roughly 10% annually. A small business owner running their own operation skips that entire chain. The return does not get divided before it reaches them. Here's the part critics always raise, and they are right to raise it. Marcus invested money, Priya invested money plus labor. That is not a fair fight, and that is exactly the point. The unfairness is the strategy. When your capital is small, your most valuable asset is not money. It is your own productive capacity. A business lets you convert that capacity directly into equity. The stock market does not. Now, the honest part, because if the script does not tell you the failure rate, it is not a finance video, it is a pitch. According to the Bureau of Labor Statistics Business Employment Dynamics data, approximately 20% of new businesses fail within their first year. Roughly 45% fail within 5 years. By the 10-year mark, about 65% have closed. Those are real numbers. They do not disqualify the strategy, but they do define the risk profile. Passive investing in a broad index fund has never permanently gone to zero. A business absolutely can. Marcus's $10,000 in the S&P 500 has never been worth nothing, even in the worst drawdown years. Priya's $10,000 could have been entirely consumed by operating losses in a failed launch. The question is not whether the risk exists, it is whether the risk is manageable and whether the asymmetric upside justifies accepting it. Research by Harvard Business School professor Noam Wasserman, published in his work on founder outcomes, found that the businesses most likely to survive and scale were those where the founder had relevant industry experience, started lean, and solved a problem with existing demand rather than manufacturing new demand. Priya's cleaning business was not innovative. It was disciplined. She entered a market with proven demand, low startup costs, and a clear unit economic model. That is not luck. That is risk management applied at the point of business selection. Here is what financially sophisticated people actually do differently. They do not choose between investing and business ownership. They understand that the two strategies serve different phases of a wealth building timeline. In the early phase, when capital is small and time horizon is long, a business can grow capital at a rate that passive investing structurally cannot match on a small base. In the later phase, when a business has been built, sold, or produces reliable cash flow, that capital moves into passive instruments where time and scale finally work in its favor. The wealthy do not pick a lane. They understand which lane creates velocity and which lane preserves it. Warren Buffett is quoted endlessly on the power of compound interest. What gets left out is that Buffett built his fortune not by passively investing small amounts, but by building and owning businesses and insurers that generated float, which he then deployed into equity positions at scale. The compounding everyone references was downstream of the business building. That sequencing is not a footnote, it is the entire strategy. Marcus is not a failure. His 10,000 is 94,000 and growing. In another 20 years, it will be a meaningful sum. He made a rational, defensible choice. But Priya, who understood that her $10,000 could purchase a revenue stream instead of a claim on someone else's, is 37 years old and recently sold her cleaning company for $240,000 to a regional service aggregator. That figure reflects a realistic earnings-based multiple for a profitable small service business, consistent with transaction data from BizBuySell's 2023 reports. She then moved that capital into index funds. Her compounding starts at $240,000. Marcus's compounding started at $10,000. Same math, different starting line. That gap does not close. That is the reframe. The stock market is not the enemy of the small investor. It is simply the wrong tool for the first phase of wealth building when your starting capital is small and your most underutilized asset is not money. It is your own labor, knowledge, and capacity to build systems. The moment you exchange that capacity for a passive return, you are renting out the cheapest version of your most powerful asset. The path from 10,000 to 1 million is not a straight line up a compound interest chart. It runs through a business that generates revenue, builds systems, and eventually produces an asset worth selling or a cash flow worth holding. Then, and only then, does it run through the market. The sequence matters. The math demands it. If this reframe hit differently, subscribe. The next video continues the thread.